friends, welcome to Nirmal Bang. This is Piyush Jain, and today we are going to be focusing on our economy. It's going to be an economic conversation. We have heard what RBI governor said in the recent policy meeting. Before that, we also talked about during our shows what has happened from US Fed, the policy meeting outcomes. We have also again talked about ECB. Host of central banks actually got reasons over the last 2 months, either to change stance or to really to take a step back and take a look what's happening. Reasons are, we all know about it. Some banks have gone down under in Europe and USA. Inflation has been on the boil continuously. It has been a complex sort of equation for the central banks to solve. And now, for us to really get it simplified and understand what it implies for the markets, for us, for the retail consumers, broadly for the economy, let's try and welcome an expert, a renowned expert. He doesn't need any introduction, but let me do the honors here. Let me now welcome Mr. Saugata Bhattacharya, the Chief Economist of Axis Bank. So welcome to the show, as always.
Thank you, Piyush. Thank you very much for the privilege of having me on your show. Really looking forward to the conversation with you.
Sir, let's build the case here of what the RBI governor actually said in the policy meeting. Were you really expecting a pause, or you were expecting a 25 basis point rate hike?
So we were in the camp of a 25 basis point hike because all the conditions, growth, inflation, that entire trade-off heavily favored a 25 hike. But at the same time, we were prepared not to be surprised by a contrary decision, a pause or a smaller rate or whatever. So yes, it was we were wrong in our call of a 25 basis point hike. But the situation had become so because with two dissents in the previous policy meet, you just needed one more dissent. And although the current growth numbers in India remain quite strong, all the high frequency indicators that we track, the PMI data, GST, e-way bills, fuel consumption, petrol, diesel consumption, etc., all of them remain strong. But remember that these are largely rear view numbers, rear view indicators. From anecdotal evidence, talking to auto dealerships, talking to real estate builders, etc., the sense we were getting is that early signs of a slowdown in demand for low ticket automobiles and passenger cars, fairly low amounts of low value real estate segments in tier 2, tier 3 markets. We were getting the sense from talking to the dealerships, promoters, etc., that situation was slowing. So demand was slowing, etc. So that is probably also the sense that the MPC and the Reserve Bank of India would have got through their internal surveys. And you remember in some of the internal survey numbers that they have shown, capacity utilization for manufacturing segments essentially was flat on a seasonal adjusted basis in Q3. In December, it had actually come down. So all of these were showing impending signs of a slowdown, given the very large pace of increases, the aggressive pace of increases that we had seen in the past. And I presume they judged that this was a time to pause and assess the impact of the previous rate hikes on economic activity, credit demand, etc.
So this is where actually, sir, I think a lot of our viewers would also be perplexed that this decision would have been largely domestic driven, or it would also be actually taking influence of what was happening outside, because you got some of the banks going down under over the last 2 months, and then RBI again basically would have seen what the US Fed actually has done it. According to you, is this something which is also driven from overseas markets?
Look, India is now quite interconnected with the rest of the global economy. So whatever is happening in the global economy will not be, India will not be completely insulated. It will not. But the fears of financial sector stability, of the bank problems that we had seen in the US and more idiosyncratically in the European area, that is not likely to have a direct contagion effect on Indian banking sector. The Indian banking sector remains very, very strong. We all know the numbers. RBI governor gave us updated estimates till December. Banks are very well capitalized. LCR ratios are high. Provision coverage ratios are very high. The asset stress in the asset system, NPAs, net NPAs is only about 1 point something in the system. So Indian banks will not probably have a very significant direct contagion effect. But a banking sector problem, if it creeps up in the developed markets, in the US in particular, will obviously have larger global spillover effects, knock-on effects via the currency, via capital flows, etc. So India would be exposed to those. But as governor repeatedly mentions, obviously, I mean, they have to keep an eye out on global developments, what the Federal Reserve does, the ECB does, what's happening to the rest of their economies, because we are also affected. Remember, by their economic slowdown, our exports are likely to slow down even further, etc. So all of that. But governor clearly mentions that while they keep an eye out on the developed markets, on external sector, uh, policy in India is typically driven more by much more by domestic, the growth and inflation balance, the external sector, macroeconomic stability, etc., price stability. So those are Indian economic indicators which largely drive Indian policy.
Right, sir. And when we take a look at that and the recent sort of numbers which are coming out, as per you, have you seen the peak of the interest rate rise now? Like, is the interest rate increasing behind us, and we're largely looking for a sort of stagnant interest rates for some time?
So on the policy interest rate front, the repo rate, my own belief is that we have peaked out. That when they have paused, I mean, they would really need for a very severe set of shocks to again resume their rate hikes. Because typically, if you look at the past, both in India, the Federal Reserve, etc., once on a rate increase cycle, it's very, very rare after a central bank pauses that they resume interest rate movements up. There are
Absolutely.
pauses after which rates are cut, but not in a hike cycle. In India, I mean, I don't remember. I think the last was in 2005 or so, with one pause in between, and then so this was the remember before the global financial crisis. So it hasn't happened in India. Very rarely in 2011 or 12 with the Federal Reserve. 2018 probably one pause. So I mean, it's a very, very rare event for once you pause to resume a rate hike. Now, of course, I mean, there is the potential for further shocks that come in. Suppose something happens to crude oil, where crude oil prices, the Brent price, Indian crude basket, suddenly goes up to 110, 115. Yeah. So, I mean, that might be an impact. Even if there is a shock in the agricultural sector. So, I mean, we are, as you mentioned in your introduction, I mean, there are increasing risks given the uncertainty in the progression of the monsoons. You've read the recent SkyMet forecast on monsoons being below average. So that probably might lead to an increase in vegetables, food, other farm produce prices. But again, as governor also mentioned, that all central banks do instrument targeting, so they have different objectives. And if the shocks, particularly from the agriculture sector, are more supply shocks, arising out of weather, arising out of other meteorological forces in the food segment, the appropriate way of dealing with those shocks are coming will essentially be largely taxes, other fiscal measures, trade measures, opening up export markets, etc., not from monetary policy. It's only when core inflation begins to move up or persist at very high levels that monetary policy will have a role. So, given all these, the fears of shocks, etc., coming in, my own sense is that for a long time at least, and if it's a long time, given that we expect inflation, RBI's inflation forecast of 5.2% for the next year. We expect that Q1 of FY24, the quarter that we are in, is likely to be somewhere around 5.1 or 5.2% because there's a sharp drop because of the base effects of high inflation in quarter one of last year. So, given this, I don't see any prima facie reason why at the next MPC meeting or one meeting beyond that, the MPC would again decide to resume pauses, unless, as we say, with the caveat that there are no large structural shocks that come into India, either externally or within India.
Right. And when I actually hear to you, and then actually I take a look at the current account balance, which we're seeing right now, how much that data is actually really important in this entire context. We are seeing a very improving trend in the current account balance.
Absolutely.
We cannot be very aggressive in saying that we might be a very strongly surplus sort of economy. There are several factors which are impacting right now. But how much importance you are giving right now in your assessment?
We are assigning a large importance to what is happening in the current account, because remember, the current account one will influence our FX, the foreign exchange, all the parameters in the foreign exchange markets. So current account, if flows dry up, the capital flows dry up, so that might affect the rupee, which will lead to other complications in domestic policy. So that's one. Secondly, in terms of the current account is a very important part of our GDP forecast. The reason for the RBI increasing its GDP from the earlier 6.4 to 6.5 for FY24, I presume, is largely the current account deficit. Because remember, initially, we also got that wrong. I mean, we started with the FY23, the last year, current account deficit. We started from about 3.5, 3.6 earlier after the Ukraine war, if you remember. And then we have started steadily shading it down, because as we saw, the progress of merchandise and services, exports and imports over the past. So our current account deficit now for FY23, the previous year, is round about with a deficit of about 2.3, which is likely to come down even more to about minus 1.9 or minus 2 in FY24. The reason for this is that, and I'm talking a little bit more in detail on this, given the importance of the current account deficit, is that one, our imports have slowed, merchandise imports, because remember, the prices of coal, of oil, of fertilizer, many of these commodity type imports that we have. So the prices have come off very significantly. So that's one. So even in FY24, our imports of fertilizers, of petroleum, of coal, etc., that value amount will be lower. Of course, I mean, that will have an impact on the exports as well, but the values of imports will contract more than the contraction in the value of exports. And secondly, in terms of exports, our services exports have turned out to be immensely resilient and strong, not just resilient, strong, because India is clearly benefiting from the cutback of budgets, etc., in the developed markets. And it's not just the ITES kind of services. You remember, Governor talked about that, an increasing range of business and professional services, exports of business and professional services, business process management, research and development, design, etc. The global capability center that he mentioned is pulling in. Data centers are mushrooming across the place. So we are doing excellently in terms of services. And frankly, I don't see those services coming down significantly in FY24. I think they will remain resilient. In addition to all of these, the trade part of the current account, remittances have remained very strong, as Governor mentioned, $107 billion in 2022, calendar 2022. And given the fact that the Gulf economy is forecast to remain very strong even into 23, we presume that the level of remittances will also be high. So that's the status of the current account. Overall, current and capital account capital flows, we project a surplus of around, say, $15 to $20 billion in FY24. So that will have an effect of supporting the rupee. Of course, I mean, remember that if our forecast is correct and some amount of capital flow is coming, RBI will also probably mop up some of the inflows from the capital account to bolster its foreign exchange reserves, which has already gone up, by the way, even if you factor in the valuation components. So I presume that the rupee is largely likely to, although I'm not a FX expert, largely going to remain in a relatively stable band that we expect in FY24. Of course, there are risks to this view, needless to say.
That's a small one, just small add-on here. By that assessment, are you believing that dollar is going to be stable? Because the economic parameter strength is definitely what you just said is going to support rupee. But if Asian counterparts we see depreciation there, then sooner or later RBI will allow the rupee to depreciate. So I'm going back to a simple question here: is that are we expecting now that there is a bit of calm and stability in the global markets and dollar will remain stable now? Is that something which is going into your assessment and calculations?
I think that's an excellent question because my apologies that I omitted to mention this. Yes, we do think that the dollar is going to remain more or less stable at these levels that you're seeing. Initially, there might be a weakness in the dollar because remember, at the next Fed meeting, we do expect a 25 basis point rise in the Fed funds rate to 525. But remember that the European Central Bank is likely to raise their rates by 50 basis points. And the European Central Bank started hiking rates later, much later than the Federal Reserve. The Federal Reserve is probably coming to a peak with the next meeting onwards. The European Central Bank will probably keep raising rates, its policy rates, over the next 2 or maybe 3 meetings. So, to that extent, till the time that the ECB outpaces the Federal Reserve, the dollar is likely to weaken slightly. But given the inherent strength in the US economy, which is more, although Europe's growth has also been surprisingly strong, but overall the US economy is likely to be more resilient than Europe, and given and with that as the underlying, the US dollar is likely to move up after the rate increase cycle is more or less stable at that point in time. But the DXY, that index of the dollar against the other major currencies, is not going to anywhere come close to those highs. You remember 115, 116. So maybe, I mean, it will stabilize at 104, 105 or thereabouts, but it's not likely to go off the charts like they had done in September, July, August, September of FY22 of 2022. On the other hand, the other currency to keep in mind is China. So China now with the CNY, the Chinese yuan, the RMB. So what China does with the RMB as a function of both the movements in the DXY and to a certain extent as a reflection of its domestic policy. Remember, if they're trying to stimulate the economy, if credit growth increases with the RRR cuts, their version of the CRR, with more money coming into the segment, obviously the CNY will tend to depreciate given the fact that more CNY is coming into the market. So that will have an impact on the entire EM range of currency, the emerging market range of currencies, including India. So there are these two factors which are so with the dollar stable and with the CNY weakening slightly, they're not going to let it weaken too much because they are afraid of capital outflows out of China. So given these two facts, I think the rupee will have a slight tendency of depreciation, very slight. And depending on then on the flows, the capital flows that we were talking about, the 15 to 20 billion dollars surplus. So how these two play out will have an effect on the overall movement of the currency. But to my mind, I mean, given the magnitudes of the movement that we expect, the rupee is likely to remain relatively stable for most parts of FY24.
Okay, and basically that sort of rounded complete circles around basically in terms of how we're looking at the rupee. For our viewers, again, why actually we're talking about the forex part was primarily because most of your raw materials, whether it's fuel, petrol, diesel, which is related to crude, processed products, whether it's edible oils, they all basically feed through into the finished product pricing and thereby the inflation, again, as Mr. Bhattacharya again was as you're talking about. Let's come back sort of to as a follow-up on our discussion, sir. On the economic front, looks like the Rabi crop estimate is looking good. It was also being highlighted by the RBI governor. Overall, yes, we can argue about it, whether the sort of the rains which have happened or any weather disturbance which has happened, how it's going to turn out in terms of the quality, but overall volume is looking good. So when you compare from Rabi volumes and then you go to the sort of monsoon rated forecast, it's a complicated exercise for you. But how you look at the rural economy and thereby the rural inflation rate, rural demand.
So the rural economy is a complicated one. I mean, it's made more complicated by the fact that we have very little data on the rural economy. So we have to use indirect indicators. One part, of course, is the agricultural economy, the farm economy. I mean, and all the risks associated with the farm economy. The farm economy, remember, is just about 35 to 40% of the overall rural economy. So the overarching, the non-farm rural economy. So it's very difficult to take a judgment call on that. In Q4, we have heard that, as indicators, FMCG sales, consumer goods item goods sales, two-wheeler sales in the rural economy remain relatively subdued. Inflation has been high, rural inflation remains high, so that's been an impediment to a revival of rural demand. But our expectation is that, given the fact that the December rural wage growth that we have seen very strong, 9% or close to 9%, so that has remained very strong. We are beginning to see signs of an uptick in demand and on some of FMCG. You hear the commentaries by some of the large FMCG companies in the rural area. You see sales of two-wheelers beginning to tick up. Tractor sales are very strong in the rural economy. MSPs have been increased. MSPs are likely to be increased even more. So the some of the rural infrastructure spends are also beginning to pick up speed, particularly state spending on rural infrastructure. So given all of these, our expectation is that rural economy should probably revive, even if not very strongly. I think from the weak part that we've seen of the rural economy in FY23, I think we'll see a revival of rural growth, the rural economy. But that creates some concerns about inflation, because if rural demand increases and there are other supply constraints feeding into the rural economy, that probably indicates that rural inflation will remain strong. So how the two, the drivers of rural growth versus the possibility of rural inflation staying higher than in the urban areas. So how these two actually play out in net on rural demand still remains to be seen. On the urban side, we'll probably, and this is the reason.
I'm just jumping in between. Apologies for that. But when you say supply constraint could come in the rural economy, are you seeing any such signs? Like, what kind of supply constraints would come? Because I'm now just matching up. If FMCG volumes were slightly subdued last time, and we are seeing some uptake whether in two-wheelers or FMCG, is that largely because of the Rabi sort of volume which is going to come? And if that is, and if there could be some fear of supply constraints, are we looking for a repeat performance? I'm not trying to solve this equation. So help us understand.
No, you're absolutely right. I'm drawing on the supply constraints from what you said earlier. I think it's the farm side, because if there are shocks on farm output, because obviously, if farmers spend more, that stimulates the broader rural economy. So if there are the supply shocks that you mentioned in terms of the risks after the post the Rabi harvest, and the Rabi harvest itself has been damaged by the heat wave in some parts, the unseasonal rains in some parts. So the Rabi itself has had a little problem, but reservoir levels, etc., are relatively okay. So, but if there is a failure of rains, which is what we have been hearing from the initial forecast that we have been seeing, so those are the supply shocks that I have in mind on the rural economy. Plus, there might be additional shocks, as I said, that if crude oil prices go up, there will be some transmission into transport fuels, feedstock, etc., which are sensitive to energy prices, to fuel costs, etc. So if that actually happens, that might be some additional shocks that come into the system. But these, at this point in time, these are largely risks rather than something that we expect to arrive. But we need to keep in mind that there is the risk, there's the potential of some shocks coming into the rural system, which might offset the better than expected Rabi incomes that we are likely to see in this month and in May.
Thank you for the clarification. And let's talk about the urban demand. Which are the pockets where you're seeing strength, and which are the pockets where you're seeing some weakness?
So from the urban demand, I think there are two counteracting forces that are playing out in urban demand. One, you remember that financial savings of households had increased very sharply in FY21. Yeah, post the COVID, because everything, consumption was slowed, was down, etc. So all of that. So household savings that year, financial savings had increased significantly, much above trend. But on the other, so that those savings have now come down, have normalized. So those savings have probably been drawn down or whatever, so will not be invested. There will not be that amount remaining as part of the disposable incomes which can feed fuel consumption. On the other side, the same story that we were talking about, the services, the strength in services exports. So all these, the data centers, the IT, the business parks, etc., that are coming up, the demand for real estate space, the commercial real estate strength that we are seeing in many cities in the country. So that is probably already putting in a fairly significant. And remember, that's largely an urban, semi-urban phenomenon. So this seems to be putting incomes in the hand, even if it's a small part of the total income earning population. It is putting money, disposable incomes, in the hands of these the employees of these companies, the services, and there are manufacturing companies as well. Yeah. So all of that. So those two are probably playing out a little bit on a contrary side. Overall net, I would expect that there will be a small increase in urban demand as well. To a certain extent, these are weather related, whatever you are seeing of air conditioners, all the cooling equipment, given the expected hot weather that we are expecting this summer. So those will expand. But you're seeing an uptick in passenger vehicle sales, particularly at the higher end, at the premium segments of the passenger vehicles, premium segments of FMCG, premium segments of the travel, hospitality, all the related service industries, travel, tourism, hotels, entertainment, etc., that you're seeing. So overall, even urban demand is likely to be relatively strong. The key thing that we need to ask ourselves in, what kind of moves are we going to see in private sector capital expenditure, private sector investment? So the overall sense that we are getting, it's still relatively muted. Manufacturing companies are waiting and watching to see what kind of, I mean, given this extreme uncertainty that now characterizes the global environment, global economic environment, we believe they're still waiting and watching to see how this evolves over a period of time. So that will be one thing to be looking out very closely for. Is there going to be a revival in the private capex cycle, particularly amongst the micro, small, and medium, the MSMEs segment? That is something which we need to watch very carefully to get a sense on potential aggregate demand in the system, particularly in the urban areas.
Right, sir. We got some good ideas about demand both in the urban and the rural economy. And with that, let me now put up my last two questions. And one question would be from the perspective of your economic forecast now. I'm trying to relate that because we maintain a sort of some correlation. Stock market, again, basically follows that. There are earnings progression. If the economy is growing, earnings progression continues. So your own sort of comment on the GDP growth, a broader sort of in the corporate universe?
So again, our forecast of FY24 GDP as of now is between 6 to 6.1%, lower than the RBI's number of 6.4, lower than even the IMF and World Bank numbers of 6.3, 6.4, etc. So it's lower, but I think the way the current account deficit, the export minus import equation is going, I believe there is some upside potential to this, to the 6.1 forecast, say 6 to 6.1 forecast that we now have. So it might eventually begin to move a little bit closer to the RBI 6.5. Having said that, I think the 6.5% RBI forecast is a little bit on the optimistic side. It's likely to be a little lower. Because remember, the point of all these increases in monetary policy is to actually slow down growth. And in a global economy which is likely to grow at 2.5%, we actually, if we keep on growing at 7% or thereabouts, other macroeconomic imbalances will set in. The current account deficit will again begin to expand, the rupee will begin to weaken. So a whole bunch of other macro problems are likely to creep up. So we should be slowing down. This is not a matter of concern that if we slow to 6% or thereabouts, that we are in deep trouble. Absolutely not. We should be slowing down in light of whatever we expect of the global economy. But it will be a moderate, and India remains far, far more resilient than all the other countries that we have seen, the large economies.
Absolutely. One subset of my question. 6.1% is fine. I think the stock market is not going to complain against you. But a lighter question will be that, are you also following the trend of the RBI governor quarter by quarter, Q1, Q2, Q3, Q4? Are you also expecting a sort of slowing down growth as we move towards the fourth quarter of FY24?
I think we are. So that's largely a base effect issue. Because although, I mean, remember, in FY23, we have more or less normalized the base effects coming in from the coming in from the post-COVID period, starting from FY21. So all the downs, then the ups, and then the levels. So I think those effects have more or less likely to have played out in FY23. So from now on, it's a question of the growth response, aggregate demand in the system. So the point is that as the effects of the interest rate increases begin to weave through the system, because remember, all the rate hikes have still not been passed through. Yeah, I mean, there's still some transmission left into actual
Yes.
lending rate in the system. And the effects of the earlier lending rates, I presume that will probably play out in Q2, Q3, etc. So that probably is one of the reasons why we expect a little deceleration of the growth momentum, leading to the 6.1, our 6.1 forecast coming into the system. So the trajectory of across quarters of growth is largely the same as the Reserve Banks at a lower level.
Okay, sir. Last question to you, and we round up our conversation, and we'll use this question as on a lighter side. I wanted to ask you, as an economist who is actually studying the economy, what is your view? Why RBI is the bank which is buying the highest amount of gold over the last many quarters, and how basically you're reading into it? Is it primarily because there's a lot of growth, there's a lot of increase in forex reserves, proportional diversion into gold reserves, or as an economist, you're reading that does RBI know more about the inflation and about the other stuff, or is it something which you're not paying much attention to it?
No. So, I mean, obviously, I don't presume to second guess RBI's portfolio decisions on how to diversify between bonds and stocks and deposits, etc. So, I won't get into that. But remember, in FY23, it's not just the RBI. All central banks have bought gold. China, in particular, a significant amount of gold purchases by China. So one is obviously a desire to diversify, exactly as you mentioned. I mean, the portfolio, the same things that all of us do. Every seasoned investor would do to diversify his or her portfolio. So that's one. And there's a little bit in addition to, because we are trying to diversify our trade away from a large focus on the dollar into other currencies as well. And having a larger gold reserve in turn gives a little bit of a support to this diversification away from the dollar, because the other currencies are not reserve currencies in the world. So if that currency is backed by gold, that gives us stronger, just like the old gold standard for the US dollar. Remember, with
Yes,
the
70s.
pre-70s, pre the 70s. So a little bit of that gold standard, probably. I mean, this is just a guess. Because it's very difficult to figure out what government policy, central bank policy thinks in terms of the asset allocation amongst its FX reserves. But I presume that would also be something that would be in their minds. I'm not sure how they're actioning on it, but that's something which I presume will be in their minds.
Well, absolutely. We'll keep guessing around, I think, because the smartest gold fund manager in the country is continuously buying gold, and that, I think, will keep following and sort of keep coming back during our conversations. But on the economy, we take home from this conversation that the urban economy continues to do well. There is a lot of disposable income which is getting generated. Rural economy, again, we heard that there is a bit of an uptake in the two-wheelers, also a bit of FMCG again, durables. In the urban economy, sort of higher premium consumption is also happening. So those are some of the things, I think, which we take home. And apart from that, the economy remains resilient. Those, I think, are the kind words coming from our chief guest today. And sir, thanks a lot for always coming on the show and enlightening us on your inputs on the economy.
It's always a pleasure to be on your show, Piyush. Always. So, and thank you very much for giving me this opportunity of, again, coming back to your show, which I look forward to. Thank you.
And with that, dear viewers, hope you enjoyed this show. Thanks a lot for watching us.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.